Hi, this is Scott McLeod from Brown Financial Advisory. Because of all the market volatility the first part of this year, I thought it'd be important for me to share a little bit of economic data that I've been reviewing over the last few weeks. Although the market is down for the year, I think the outlook is maybe a little less negative than the media portrays, and therefore I wanted to spend a little bit of time just sharing what the projections look like, where we are today, and give you a feel for what valuations look like going forward, and also to take into consideration what higher oil prices might be and the impact that it might have on U.S. GDP. So take just a few minutes to talk with you, and thank you for joining me. The first thing is our agenda, and the first part of the presentation is about where the market is right now and what that means in terms of valuation. We have seen the market decline in the US and in global markets, but not nearly as far as the media might imply. So I'd like to share that with you and also what that means in terms of valuations. The next part of the presentation will be about earnings growth and what earnings growth projections look like for the rest of the year. So the first part is about market performance and valuation. As you can see, the S&P 500 has declined from its peak of about 2% positive to about 3.5% negative. So we're declining about 5.5% total from its peak. After a really good year last year, it's only down about 3.5% this year. So net over net, it's not too bad for the year, the 12-month period, but we're seeing declines of about 3.5% year to date, and we haven't seen that in some time. The Russell 2000 is small company stocks, and believe it or not, those stocks are actually still positive for the year, but only about 0.5%, and that's after declining a good 9% from the peak of this year. So we have seen some significant declines in the US market, but the US market is not nearly as responsive to oil price shocks as it has been in the past. And I think right now we're trying to assess how long this will be and quite frankly, how impactful it will be on earnings. One thing that is a positive for the US market is we've seen valuations decline. So there is an important part of the S&P 500 where you consider both the price and the company earnings, and that would be a PE ratio, a price to earnings ratio. A typical ratio is around 16 or 16 and a half, but we've most recently been almost as high as 32. And since that time, that valuation has declined. And currently, the Magnificent Seven is trading at about 25 and a half times earnings after being upwards of 32 times earnings. The S&P 500 as a whole is about 20.8 times earnings after being as high as about 23 times earnings. Now, this is still rich by historical standards, but as the prices have come down, the earnings projections really have not softened a whole lot yet. And therefore, valuations for the US look really a little more positive now than they did earlier this year. Additionally, when you look at mid cap and small cap stocks, those stocks are trading at 16 times earnings and 15 times earnings. And therefore, those are really quite close to the average, as you can see from this longer term graph. If you draw a line right through here, that's going to be about the average. And they're trading at a pretty fair valuation overall. So the US market is a little bit expensive and forward earnings are still looking pretty good, but the prices coming down have improved valuations overall, which gives us more upside in the portfolio in the future. So what does this mean for valuations and the projections going forward? First of all, you should know that valuations and growth expectations for both 2025 as we wrap up the last year and also for 2026 look really quite positive. You can see here from this graph that the earnings projections, the estimates right now are coming in at around 11.3% growth in earnings. In 2026, those earnings growth expectations are around 15.1%. That's substantial. It's actually really quite incredible. But the companies are reporting really strong earnings expectations and have been improving those expectations, increasing those expectations for the last few quarters. Now, this is interesting that this is a 15.1% projection on a 7.5% annual growth rate since 1991. So this 7.5% is pretty consistent over time, and yet we're seeing 15.1% as the earnings expectations for 2026. Now, this is important because this is what drives the stock prices, and stock price forecasts are actually still quite positive as well. So this is from Yardeni Research and was published in March 2026, March 11th of 2026, but it's based on December 2025 earnings forecast and growth projections. And this is the S&P 500. Now, one thing is you should see here, these are various research shops all around the country. The S&P 500 had a closing price point around 6,800. And as you can tell, every single one of the forecasts are positive for the S&P 500 for the year. Now, as you know, forecasts are made to be broken. And so anything can modify these expectations. But even as recent as December, we are seeing growth forecasts for the S&P 500 that average 7,555 above 6,800. So this is a substantial increase in the S&P 500 growth and the S&P 500 forecast. Now, of course, if we see higher oil prices and those oil prices are higher for longer, that's going to have a negative impact on GDP growth and also likely the growth of the S&P 500. So what Vanguard published was their expectations for 3 different scenarios: de-escalation, a moderate period of time where we see higher oil prices and the decline the higher oil prices last for 1 to 2 quarters, and then protracted where we see more than 2 quarters and oil prices above $100 a barrel. So you can see in the US, this is important to see, 1 month de-escalation only hits our GDP growth by 4 bips, whereas GDP declining 10 basis points in a moderate scenario and 20 basis points in a protracted scenario. 20 basis points is about a 10% hit to GDP growth, which obviously would slow earnings and probably erase most of the earnings expectations for the United States going forward if we saw 20 basis points of GDP contraction. In addition to that, we would expect inflation to be increasing as well. So headline inflation would grow 16 bips in the de-escalation scenario, or potentially 0.8% in the protracted scenario. 0.8% is a substantial increase in inflation. Core inflation would increase less because core inflation does not include energy. If you look across the rest of the world with the Euro area and Japan, you can see that the impact to GDP from a basis point perspective is higher, but actually a percentage of expected growth is substantially higher. So if we saw a protracted scenario in the Eurozone, this would erase about half of the expected GDP for the year. And in Japan, the 48 basis points is not quite half, but it's also a similar impact in Japan. So international stocks and international growth rates would decline substantially if we saw a protracted conflict with Iran and we saw oil prices increase above $100 a barrel and stay there for more than 2 quarters. This would be a real problem for growth around the world, and we would expect the stock prices to either stabilize and not grow or potentially pull back across the globe a little bit. So that should be an expectation that could be on the table if this doesn't wrap up pretty quickly with Iran. However, I should remind you that the market works in long cycles. And this is a wonderful graph going back to 1957 that just shows some of the examples of things that have happened throughout the year, like in 1994, the Mexican peso crisis, or the Persian Gulf War, or the Lehman Brothers bankruptcy during the subprime meltdown. And you can just see that over time, the S&P 500 continues to grow, the stock market continues to grow in spite of these things. What seemed like a dramatic decline in March of 2020 when the coronavirus hit, and we saw a 30% decline in the stock market, almost seems like ancient history now. The whole takeaway is that this will pass, and while it may dent the GDP growth for the year, if we see a protracted conflict in Iran and the oil prices rise substantially, it will not be a permanent situation, and we would expect those prices to continue to rise, and earnings expectations are continuing to be positive in spite of what we're seeing throughout the world and in spite of the rising oil prices and the increases in inflation. So I hope you feel encouraged that things are on the right path and that we're in a good spot with regards to what's happening in the economy. And I suspect that we'll continue to see continued growth, and hope that you'll feel comforted that the portfolio is in a great position to do well over time. Thank you very much for your time. I hope you'll let me know if you have any questions, and we'll look forward to seeing you soon.